It is the middle of May 2009. India has just finished counting the votes of a general election. And every single person on Dalal Street, every analyst, every trader, every pollster, was certain of one thing. India was getting a hung parliament. Nobody would get a majority. The market had already priced in the chaos. They were all wrong. At 6:30 in the morning, in Singapore, the futures opened 20% higher. At 10 o'clock, when the Mumbai exchange opened, the Nifty hit its upper circuit within seconds. Trading halted for an hour. The exchange reopened, and the index rose another 10%, 20% in one day. Short sellers lost everything. One trader's 2 lakh rupees became 2 crore. A friend of mine, short just one lot of stock futures, lost more money than he had. The lesson written in fire: black swans go up too. This is the story of the Indian stock market. The crashes, the scams, the wars, the elections, and the days when the impossible happened. This is every moment that mattered from 1980 to today. This is the history every Indian investor should know before it happens again. Before the Nifty existed, before screens, before algorithms, the Indian market was a room full of shouting men at the Bombay Stock Exchange. And in 1980, that room witnessed something the world would not see again for 40 years. Reliance Industries was planning a convertible debenture issue. A cartel of bear operators decided to short the stock into the ground. They were wrong to pick this fight because on the other side was Dhirubhai Ambani. Dhirubhai reportedly funded a group of friendly brokers. History remembers them as the Friends of Reliance, who bought every single share the bears threw at them. The shorts were cornered. They could not deliver. The crisis got so bad that the Bombay Stock Exchange shut down for 3 full trading sessions to broker a compromise. It was a GameStop-style short squeeze, 40 years before GameStop. And it created a rule that traders still whisper today: never short Reliance. In 1982, a Calcutta bear cartel tried again, and Dhirubhai punished them even harder. When they needed shares to deliver, there were none. So Dhirubhai sold them the shares himself at a huge profit. The bears paid him to lose. Then came 1991, and the scam that changed everything. Harshad Mehta, the big bull. He moved bank money into the stock market using bank receipts and the ready-forward market, and the Sensex went vertical on his buying. When it unraveled in 1992, the market fell roughly 50%. It took 3 years to fully recover. But out of that wreckage came the system itself. In 1992, the National Stock Exchange was set up. SEBI, the regulator, got real powers. In 1994, NSE began operations with electronic screens replacing the shouting. And in 1996, it launched an index of its 50 biggest stocks. They called it the Nifty. The stage was set. The late 90s were India's first tech fever. IT stocks went vertical between 1998 and 2000. Companies like Pentasoft traded at 2,000 or 3,000 rupees. And then the dot-com bubble burst, everywhere at once. The Indian market crashed with it. Most of those companies simply vanished. Pentasoft? Worthless. But the survivors, TCS, Infosys, HCL Tech, Wipro, didn't just survive, they swallowed the entire industry. Around the same time came the Ketan Parekh scam, India's second great market manipulation, a reminder that the 90s boom had a dark underside. And then, in 1999, India went to war, the Kargil War with Pakistan. The market's reaction? The Nifty fell about 5 to 6% and recovered strongly. That number, 5%, would become the benchmark for every India-Pakistan crisis that followed. 2001 brought the attack on the Indian Parliament. The market fell 4 to 5%. And 2001 did something darker. It became the last year, for 25 years, when the Indian market closed in the red for 4 straight months. Then, in 2003, a single car company changed everything. Maruti came to the market with its IPO. It was the spark. Suddenly IPOs were hot again, money came back, and the Nifty, which had bottomed around 930, began one of the greatest bull runs in Indian history. By 2005, it had more than doubled, and it was just getting started. From 2003 to 2007, the Nifty rose almost 7 times. The Sensex rose 700%. It was the mother of all bull runs, led by infrastructure. Any stock with infra in the name flew. Punj Lloyd listed at 10 rupees, relisted at 700, and years later went back to 10. But here's the part nobody tells you about that legendary bull market. Every 6 months, it crashed. Every 6 months, more than 10% gone. And most traders still lost money because the swings were so violent that they got shaken out again and again. And in the middle of that 7x run came the most brutal election shock in Indian market history. May 2004. The BJP campaigned on India shining. Every exit poll said they would win. The market was priced for victory. And then the results came, and the BJP lost. Vajpayee was out. The market crashed nearly 30% in the post-election sessions. 30%. On a result nobody saw coming. It was one of only 3 times in 25 years the Nifty fell more than 20%. But here is the twist that defines this entire story. After the 30% crash, the market rallied 4 to 5 times into the 2007 peak. The worst election shock in history became the greatest buying opportunity in history. And quietly, in the background of that decade, a pattern was born. In 2004, the government launched an ONGC share sale of 40,000 crore. It received less than 1,000. The entire shortfall, 39,000 crore, was absorbed by one buyer, LIC, the Life Insurance Corporation. The state insurer had just become India's buyer of last resort. Remember that. It will matter again. And in that same year, 2004, a quiet policy decision planted a seed that would grow into one of the market's longest-running grievances. The government abolished the long-term capital gains tax and introduced the securities transaction tax instead, a small tax on every trade, paid whether you made money or lost it. Nobody imagined that seed would one day strangle the market's liquidity. But keep it in mind, it comes back again and again for the next 20 years. January 2008. Reliance Power launches its IPO. It is oversubscribed like nothing before it. Investors fight for shares. It was the top of the market, and almost nobody knew it. In that same January, the Nifty fell nearly 10% in a single day. India was cracking months before the rest of the world. And then, in September, the real disaster. Lehman Brothers, allowed to fail on a Friday evening. The global financial system froze, and the Indian market, which had already been falling since January, went into freefall. The Nifty fell from 6,000 to a low of about 2250, a 50% crash, the deepest in its history. The market hit its lower circuit during the collapse, the biggest red candle India had seen since 1995. But March 9, 2009 was the bottom. And what happened next shocked everyone. With the US Fed at 0 rates and printing money, The Nifty rallied more than 100% within 12 to 15 months. 100% in a year. The ball dropped from a great height and bounced even higher. And then, in May 2009, came the single wildest day in Indian market history. Everyone expected a hung parliament. The Congress-led UPA won a majority without the communists, which nobody thought possible. Vote counting was on a Saturday, so traders had an entire weekend to imagine the damage. On Monday morning at 6:30, Singapore Nifty futures opened 20% higher. At 10 o'clock, Mumbai opened. Upper circuit within seconds. Trading halted for an hour. The exchange reopened, and the index rose another 10%. 20% in one day, 2 upper circuits. It may be the biggest one-day index move in the history of any stock market on Earth. Short sellers were obliterated. The next few years were quieter, but they built the machinery of the modern market. 2011 brought the Eurozone crisis. Greece and Italy near bankruptcy. The first ever downgrade of the United States credit rating, and a grinding year-long slide that took the Nifty down about 20%. No single crash day, just FII selling, month after month. And then, on the 5th of October 2012, the market did something impossible. A dealer at a brokerage was instructed to sell 50 lakh rupees of shares for a foreign client. He sold 50 lakh baskets, meaning 50 lakh times the entire Nifty 50 in index weights. In seconds, the Nifty crashed about 15%, nearly 1,000 points. It fell so fast the 10% circuit breaker could not trigger in time. But here is how you knew it was an error. The Nifty futures barely moved. They kept trading at 1,000-point premium, because traders understood that no real news could justify a 15% fall, so it had to be a mistake. The trade was reversed. The market recovered the same day. The cash market had crashed 15%, and nothing had actually happened. And then came 2013, the year the Federal Reserve humbled India. Bernanke signaled the Fed would taper its bond buying. The taper tantrum hit emerging markets like a bomb. The Nifty fell 20%. The rupee collapsed to 69 to the dollar. Foreign money fled. The finance minister hiked the gold import duty from 1% to 10% to defend the currency. And in the middle of that panic, on one day, something remarkable happened. The market opened down another 2%. And then, in the afternoon, a wave of buying took it from -2 to +4. Reports said LIC had entered the market. That day's low was never tested again. From around 5,100, the Nifty rallied 80% over the next 2 years. The state insurer had marked the bottom again. Now, a quick experiment. In May 2014, the BJP won the general election, exactly as everyone expected. The Nifty rose 1% on result day. In 2019, same story. BJP wins, expected again, Nifty rose 0.5%. Compare that to 2004's 30% crash and 2009's 20% rally. Same event, opposite reactions. The lesson could not be clearer. The market does not react to results. It reacts to surprises. August 2015. China devalues its currency. World markets gap down. The Indian market falls about 20% before bottoming, making 2015 the worst year since Lehman. And once again, when the market was down around 6,000 and fear was everywhere, LIC reportedly stepped in. Nifty jumped 4 to 5% in a session. That low held for years. Around the same time, Raghuram Rajan taught India its most quoted market rule. Everyone expected a rate cut. He didn't cut, and the market fell. Days later, outside any policy meeting, he cut rates unexpectedly, and the market shot up. When asked why, he said simply, "Don't fight the RBI." And in 2015 came a blue-chip crash that became a legend of a different kind. The Maggi ban. Nestlé India fell 20% when Maggi noodles were banned over food safety findings. Those who bought the crash? They made 400% as the stock recovered and kept rising. Bad news, good company. Then, November 8th, 2016. Two shocks in one night. India announced demonetization. 86% of the currency invalid overnight. And on the same day, Donald Trump won the American election. Global markets crashed. India double crashed. But the sequel is the part everyone forgets. As black money was forced into the banking system, it flowed into the stock market. The Nifty rallied from about 8,000 to 11,000 over the next 2 years, one of the great bull runs of the decade, launched by one of the greatest shocks. February 2018, US inflation data. The Dow fell 5% during market hours and another 5% after hours, 10% in a day. The next morning, India gapped down 400 points. And just days earlier, India had inflicted its own wound. The 2018 budget reintroduced the long-term capital gains tax, the tax that had been abolished back in 2004 and replaced by the STT. Now, traders were being taxed twice. The tax shock at home, the crash abroad, a double whammy that took the Nifty down about 700 points in a single month. That was the year the Indian financial system started cracking. September 2018, IL&FS, a company with a lakh crore of exposure, collapsed. Then DHFL, a fund sold its bonds at a discount. The market read it as a death signal, and the stock fell 60% in a single day. Yes Bank fell 30% in a day when Rana Kapoor exited. A Nifty stock falling more than 25% intraday hadn't happened since Lehman. And the mid-cap index, the retail investors' playground, crashed 30% and did not recover for 2 years. In November 2018, the BJP lost all 5 state elections. Foreign investors concluded 2019 would produce a hung parliament, and sold Indian stocks every single day from late November to the end of February. And then, on the 26th of February 2019, Indian fighter jets crossed the border. Balakot. The jets came back safely. The national mood flipped. And so did the foreign investors, from relentless sellers to aggressive buyers. The Nifty rose about 1,000 points in a month. One geopolitical event reversed 3 months of selling. The market rallied into the election, which the BJP won. Then came the strangest crash of the era. May 31st, 2019, around 11:30 in the morning. The market was green. Then, within minutes, Bank Nifty fell 1,000 points, with no explanation. 2 minutes later, the news broke. Nirmala had been appointed finance minister. The market had expected Amit Shah. The market recovered the same day. But the name Nirmala was now a market event. Her first budget in July 2019 imposed a surcharge on foreign portfolio investors. FIIs sold in protest. The market fell hard. Traders named the giant red candle on the chart the Nirmala Sitharaman candle. And then, on the 20th of September 2019, she did the exact opposite and created the greatest policy rally in modern Indian history. With no warning during market hours, corporate tax cut from 30% to 22% in one stroke. The market exploded. Nifty shot up 5 to 7% in a day, Bank Nifty over 2,000 points and about 10% across 2 sessions. Short sellers were annihilated. Traders now call it the Nirmala candle 1.0, the white swan. The same minister. 2 candles, one red, one green. The market had learned that in India, policy is a weapon, and it can fire in either direction. The 1st of February, 2020. Budget Day. On a Saturday, in a special NSE session, the Nifty fell 3.26%, the biggest budget day move in 10 years. But it wasn't the budget. That was the day the coronavirus spread beyond China to 7 more countries, and the world's panic began. A finance blogger had written 2 days earlier, "When everyone is thinking of budget, I am thinking of coronavirus." 6 weeks later, the market hit its first ever lower circuit. March 13th, 2020, the first lower circuit in Nifty history. March 24th, the bottom, 7,511. A 40% crash from the highs in about a month. India VIX exploded from 15 to 85. Foreign investors sold for 18 straight sessions. And here is the cruelest irony of 2020. When the market crashed 40%, India had almost no COVID deaths. The market wasn't pricing the present. It was pricing 6 months of future damage. That is what markets do. April 20th, 2020. Oil went negative, minus $37 a barrel. With storage full and delivery impossible, sellers were paying buyers to take the oil away. It had never happened in history. Indian markets fell for 2 days. And in the same month came the strangest market crash of the year, one almost nobody understood. Franklin Templeton wound up 6 debt mutual funds. That sounds like a debt market story. But thousands of options traders had pledged those debt funds as trading collateral. When the exchange set their collateral value to 0, they were forced to liquidate positions, and the stock market crashed on a Friday afternoon. A debt fund crisis crashing the equity derivatives market through a hidden chain, a genuine butterfly effect. And then came the recovery that nobody believed possible. From 7,500, the Nifty crossed its 200-day average around 10,800 and rallied to 18,600 by late 2021, more than double. On the 5th of February 2021, it crossed 15,000, doubling from the COVID low in under a year. It was the greatest bull run in Indian market history, and for most of it there was not even a 10% correction. The ball had dropped from a great height, and it bounced even higher. But a bull market that rises without falling creates a new kind of investor, the kind who has never seen a real crash. And in 2021, that investor met reality. January 2021, GameStop. A US meme stock squeezed by a Reddit army, and the fear rippled across the world. Nifty fell 900 points in 4 sessions. Not because of anything Indian, because a video game retailer in America broke the global risk mood. Then, February 26, 2021, the heaviest single day of foreign selling in Indian history. FIIs sold over 8,000 crore. Some estimates put the gross figure above 13,000 crore, beyond anything seen even during COVID or Lehman. Nifty fell 700 points intraday. Bank Nifty over 2,000. Every single one of the 50 Nifty stocks closed red. And then, April 2021, the second wave. 3 Mondays in a row, the market crashed. April 5th, Maharashtra restrictions, Nifty down over 400. April 12th, more restrictions, down over 500. April 19th, the perfect storm, pandemic horror, a Bitcoin crash, weak HDFC Bank results, foreign selling. Nifty broke support to 14,200. But here is the law the market taught that year. The first COVID wave crashed the Nifty 40%. The second wave, far deadlier, with oxygen shortages and hospital queues, took it down only about 10%. Markets do not crash twice for the same reason. And November 2021 proved it again in reverse. The Omicron variant appeared. Nifty fell 600 points in a day and 900 points across 2 sessions in December, with 0 Omicron deaths in India. Bank Nifty fell 20% from its highs. Pure fear, no fundamentals. And then the market recovered it all within weeks. December also delivered a very Indian kind of chaos. One weekend, the RBI replaced the CEO of RBL Bank overnight. The stock fell 25%. Rumours flew. Rakesh Jhunjhunwala buying a stake, other banks next. Bank Nifty swung 1,700 points in a day. The RBI had to clarify that the bank was fine. Morning news, evening reversal. The market's oldest story. February 24th, 2022. Russia invades Ukraine. The world expects markets to collapse. Instead, something strange happens. When US sanctions exempt Russian oil and gas, crude crashes from $105 to $95. And the Indian market rallies. Short covering, relief. P.R. Sundar's line for that day became famous. The fear of war is worse than the real war. But the fear came anyway. Swift sanctions, the ruble halved. And by March 8th, the Nifty hit 15,671, its war low. From there, it rallied to 18,200 and crashed back to 15,700 by mid-May. 2,000 points down, 2,000 up in 2 months. And in the middle of that chaos, India's biggest ever IPO came to market. LIC, the same LIC that had rescued the ONGC issue in 2004, that had marked the market bottom in 2013. It listed on the 17th of May 2022 at a discount of 60 to 70 rupees to its issue price. The saviour of last resort needed saving. Indians had always paid a premium to LIC. The LIC share itself had no premium. The shocks kept coming all year. June 16th. Switzerland hiked interest rates for the first time in 15 years, and the Nifty broke its 52-week low in a one-way fall. July 1st. The Indian government slapped export taxes on petrol and diesel overnight. Reliance, a 12% weight in the index, fell 8%, dragging the Nifty down 300 points almost by itself. And behind all of it, the macro war. US inflation hit 9.1%, a 41-year high. The Fed hiked relentlessly. Foreign investors sold 40 to 50,000 crore every single month for over half a year. So relentlessly that an RBI deputy governor published a paper warning that FII selling itself could become a black swan for India. But the market did not collapse. It fell from 18,000 to 15,200, a mere 15%, because retail investors, through their monthly SIPs, absorbed the selling. The RBI's feared black swan never came. The retail army had become the market's immune system. That was the real story of 2022, and it set up the battle of 2023. January 24th, 2023. A tiny American research firm, about 5 employees, published a report. It accused the Adani Group, India's largest conglomerate, of fraud and stock manipulation, and claimed the stocks were overvalued by 85%. It also disclosed it was short. What followed was the most destructive single-group crash in Indian market history. Adani stocks fell 70 to 75% on average in a month. Adani Total Gas hit the lower circuit 19 straight days. Over $100 billion of group market value evaporated. LIC, which had invested 30,000 crore in the group, showed paper losses of 35,000 crore. And the Nifty, while global markets rallied, fell about 1,400 points, roughly 8%. India decoupled downward, becoming the world's worst-performing major market in early 2023. The echoes were uncanny. In 1982, Calcutta bears shorted Reliance, and Dhirubhai crushed them. In 2023, a foreign short seller attacked Adani, and this time the shorts won. Then came Budget Day, the 1st of February, and the most violent day of the saga. At 1 o'clock on Budget Day, Credit Suisse announced it would no longer accept Adani bonds as collateral. Traders who had pledged those bonds were forced to square their positions. Adani Enterprises and Adani Ports went into free fall. 10% lower circuit, then 15, 20, 25, 30. Nearly 35% down. Bank Nifty swung 1,500 points up, then 2,500 down. Nifty touched 17,400 and recovered. And days later, Adani cancelled its follow-on public offer, something no large Indian company had ever done. A green budget day had been turned red by one bank's collateral decision. The market's plumbing had crashed it faster than any news could. March brought a fresh earthquake from America. Silicon Valley Bank collapsed, 60% down in a day, and the contagion swept through banking stocks worldwide. In India, the market fell over 1,000 points in a session, and Bank Nifty broke 40,000. 6 central banks took coordinated action, a move last seen in 2008. The 2008 playbook rerun in miniature. And then, at the end of 2023, came the December miracle. The BJP swept 3 big Hindi belt state elections, a surprise, and in the same breath, the US Fed signaled rate cuts were coming. Local positive, global positive, together. The Nifty exploded. 1,500 points in November, another 1,500 in December, from 19,000 to 22,000. A 15% 2-month rally. Bigger than a typical full year's return. The stage was set for the wildest election year since 2009. January 2024 opened with a reminder of concentration risk. HDFC Bank's quarterly results triggered a 1,500-point gap down in Bank Nifty, closing 2,000 points lower on the day. One bank's results made the entire market fragile for 6 weeks. Then SEBI did something unusual. It warned publicly about froth in mid-cap and small-cap funds, and told mutual funds to moderate inflows. The market fell 300 points the same day, with the real damage in the small caps. A regulator pricking a bubble in public. It was the 2018 mid-cap crash's modern echo. April brought a double shock. India scrapped Mauritius tax treaty benefits for foreign investors, and Israel and Iran traded strikes. Nifty fell 1,000 points in a week, and recovered 70 to 80% the very next week. The buy-the-dip reflex was now automatic. Then, June 4th, election result day, and for a few hours it looked like 2004 again. Exit polls had projected a BJP landslide. Early counting showed something else, the ruling alliance short of a comfortable majority. The market crashed intraday. But the government formed, the market recovered, and then launched a 4,000-point rally over the next 4 months. On the 30th of September, 2024, the Nifty closed above 26,000 for the first time in history. And then it fell. Quietly, without a Lehman, without a war, without a single headline. Foreign investors sold 64,000 crore in half of October alone, a pace matching the COVID panic month. By early 2025, Nifty was at 21,750, 16% off its peak. Blue chips down 20 to 40%. And then it chopped sideways. For 13 months, the Nifty went nowhere. It took until October 29th, 2025, 13 months, for Nifty to reclaim 26,000, a whole year of zero return. The new generation of investors, who had only ever seen the V-shape, learned what a grind feels like. And then came the era of the tweet and tariff. 2025. Trump's tariff war. 25% on Canada and Mexico, 20% on China, threats escalating every week. Global markets wobbled. But the Indian market did something new. It fell first. It had been falling since late 2024. And it recovered first, and most. More than 10% in under a month in the April series alone. Then, on May 12, 2025, came one of the strangest single days in Nifty history. India and Pakistan announced a ceasefire. The Nifty shot up 4%, about 1,000 points, in a single day, from 24,000 to 25,000. The biggest one-day geopolitical rally of the modern era. And then, nothing. For 6 months, Nifty traded in a 25,000 plus or minus 3% range. A 1,000-point day, followed by half a year of silence. June 2025. Israel attacked Iran. Nifty gapped down 300 to 400 points and recovered the same week. The Kargil pattern 30 years on. War headlines now dent India for days, not months. The RBI cut rates 50 basis points. GST rates were cut in September. The market absorbed everything. And then, in the first quarter of 2026, war came to the market for real. The US and Israel struck Iran. Oil spiked from around $55 to $120. Foreign investors fled, bombing the Indian market, in the words of one commentator. From an all-time high of 26,400 in the first week of January 2026, the Nifty broke 23,000. 13% down in under 3 months. And then, on April 8th, 2026, a ceasefire. Oil crashed from $120 to $86. Gold fell from 5,600 to 4,000. The Nifty jumped 4% in a day. The war era had arrived, and with it, a market that moved on headlines alone. And in the middle of that war, February 3rd, 2026, produced one of the most shocking openings in market history. An Indo-US trade deal was announced, with no prior negotiation news. Gift Nifty indicated a 2,000-point gap up. The Nifty opened more than 1,000 points higher. And then the selling began. By the close, the entire gain was gone. The biggest indicated gap up since 2009 completely faded. And the market grew stranger still. In March 2026, Iran ceasefire headlines, appearing only on a couple of Indian channels, nowhere on Bloomberg or Reuters, spiked the Nifty 400 points in 20 minutes on multiple days, including expiry day. Fake news moving the index. Suspected manipulation. Then came the policy shock that hit traders where it hurts most. On the 1st of April 2026, the government hiked the securities transaction tax by 150%. Overnight, Nifty futures spreads widened from half a point to 10 or 15 points. Volume collapsed. The market's plumbing The very liquidity that makes trading possible began to break. And finally, May 2026. The strangest crash trigger of them all. The Prime Minister told the nation India faced one of the worst crises in the last 10 years and asked citizens to conserve foreign exchange. The market's verdict was instant. Nifty fell 400 points on Monday, another 400 on Tuesday. 800 points in 2 sessions because of a speech. 45 years. Scams, wars, elections, pandemics, a flash crash, a 20% day, a 40% crash, and a 7x bull run. And through all of it, 6 patterns never changed. 1. The market moves on surprise, not on news. 2004 crashed because nobody expected it. 2009 exploded for the same reason. Expected results, 2014, 2019, moved nothing. 2. The first shock hits hardest. A 40% COVID crash, then a 10% second wave. Markets don't crash twice for the same reason. 3. India falls first and recovers first. In 2008, in 2025, Indian markets front-ran the world down and led it back up. 4. Beneath every move, there is a hidden war. FII versus DII. Foreign money flees, domestic money, LIC in 2013, the SIP army in 2022, catches it. 5. Elections are the biggest single-day movers in Indian market history. A minus 30% day, a plus 20% day. Nothing else comes close. And 6. The most important one. Black swans go both ways. The Nirmala candle. The 2009 gap. The ceasefire day. The market can destroy you on the upside just as fast as it can on the downside. So the next time the market does something impossible, remember, you've seen this movie before. The only question is, are you positioned for the surprise?